Thank you, Ian. Thank you, Peter. I'm the CEO of a very conventional producing oil and gas company. We have production and exploration assets in Egypt and in Morocco. We currently produce about 7,000 barrels of oil and gas equivalent per day. We have a fully funded and very exciting exploration programme that we are about 1/3 of the way through at the moment. We'll be drilling 8 wells in 2020. 6 of them are appraisal exploration, which would have, upon success, a meaningful impact on our business. We currently have about 13 million barrels of 2P reserves, which is equivalent to about 5 years of production. Upon success of these wells, the reserve life could increase to 9 times production. We're currently valued at $69 million, which is approximately 2 times of our 2020 operating cash flow. And we have a lot of interesting activity in front of us, and I welcome some questions at the end. We announced this morning our 2019 operational update and our 2020 guidance. The key takeaways from that is that our production in 2019 is 12% up on 2018. Our 2020 production guidance is approximately 70% up on our 2019 actual production. So as I said, we are producing approximately 7,000 barrels of oil and gas equivalent. Last year we produced just over 4,020. Our 2019 actual production outperformed our guidance across all of our assets. We achieved a major operational milestone during 2019, which you can see in the production. We brought on stream a very large gas producing asset in Egypt called Souq to Souq. Souq to Souq in of itself will contribute approximately 4,000 to 4,400 barrels of oil equivalent of our 7,000 barrels a day guidance. So we have made a quite major step in terms of the growth of the business. I mentioned our upcoming exploration programme. All of that is currently fully funded from our existing cash and operating cash flow, and we have a debt facility provided by the EBRD, which is undrawn, and we expect to remain undrawn throughout. So we are in a very, very interesting position in terms of having a fully funded work programme with the potential of increasing our reserve life from its current 5 times to 9 times. And 8 of those wells will be drilled in the next 6 months. 6 of them, as I say, are high impact exploration and appraisal, one of which is currently drilling, and we expect the results of that during next week. We have a very diverse institutional shareholder register. Our largest shareholder is a large Abu Dhabi listed equity fund called Waha Capital. Waha Capital have a board position. They're very supportive of our future growth, both from the existing portfolio we have and to look at inorganic growth opportunities. I want to talk now about our core assets. Spend most of the time. We've got 3 categories of core assets, 2 licenses in Egypt and 5 in Morocco. And I'll start with our largest and I guess most valuable asset in the portfolio, which is an asset called Souq to Souq. This is the asset that we brought on stream in November last year. We had a very tight schedule to build the asset, commission it and bring it to first gas. We achieved that in November, and we managed to increase production to the current rate of about 50 million standard cubic feet per day. In oil and gas terms, that's about 8,500 barrels of oil equivalent, and we've got a 55% interest in that asset. That asset will generate at that production level operating cash flow of between $11 and $12 million of free cash flow per annum. We've currently had a reserves review undertaken by one of the reserve auditors called Gaffney Klein. They've allocated 89 BCFE to that, and we're going to undertake a drilling programme in South to Souq starting in February, which has the potential to double that, and I'll talk a little bit more about it. The next couple of slides I won't dwell on, they're in the pack. It's just a picture of what the facility looks like, and that diagram says it's a very simple facility. It takes gas in, it knocks out water, it knocks out condensate, and we sell the condensate along with the gas. The South to Souq drilling programme is arguably the two major catalysts that we have in the portfolio in terms of their potential to increase the underlying value of our business. Our discovered resource, our producing 50 million standard cubic feet a day, is in this blue area, which is a 25-year development lease. As I say, we built the infrastructure, we built the pipeline, and we drilled 4 discoveries in here. Brought that on stream in November. In February, we will spud a well here called Salah, and immediately after, we will spud a well here called Sobe. Salah and Sobe are coloured orange, A, to make them stand out, and B, to let you know that the prospectivity, the gas that we're targeting in Salah and Sobe, is from the same geological horizons as we have discovered gas in the 4 existing discovery wells that we have. They have about a 35–36% chance of success, and the reserves that we are chasing in Salah and Sobe is about 103 BCF, or more than 1.1–1.2 times the size of the existing reserve base. If Salah is successful, I talked about the move from a reserve life of 5 years to 9 years. Salah, if that's successful at that level, will contribute another 2.5 years of reserve life for the whole company. And if Sobe is successful, it will add another incremental 1.5 years. So with these 2 wells alone, which drill in February and in April, there is the potential for a reserve life to increase from 5 years to 9 years. So very, very interesting and exciting activity for us. There is a third potential well that we would like to drill in 2020 called Young. It's coloured differently because, as you can see down here, it's got a very different risk profile. It's got a 17% chance of success, which is a high risk well, and it's not something that we want to drill without a partner. The well cost is only $4 or $5 million. We could drill it if we want, but in terms of good risk management, you would want someone else to come in and partner with you in that project to validate your geological assumptions. We may bring a partner in there. If that happens, the partner will pay the full cost of drilling the well, and we would also offer them some share in a discovered resource and a share in any future discovery, if the price that they offer to take a share of the equity is acceptable to us. So we're definitely drilling these 2. The well site and the rig is arriving here. As I say, this will be a mid to late February spud, and we expect this will be a late April spud. So 2 very, very exciting wells. Our other core asset in Egypt is an oil-producing asset in the Eastern Desert. This is down near Hurghada for anyone who goes to Egypt on holiday. This is a very low-cost, predictable oil asset where we have a 50% share with our partner, a local Egyptian company. It's effectively a cash cow for us. It generates operating cash flow of around $5–6 million per annum. We drill 2 or 3 wells per year, and we keep production around 4,000 barrels per day. We plan to drill 3 wells in 2020 to maintain that. The guidance that we put out this morning shows a step down from the 4,000 to about 3,300, purely as a result of a question mark around when we will drill the wells. The way the dynamic works is the reservoir produces, depletes, and is replenished when you drill wells. We would like to drill the 3 wells earlier in the year. There may be a risk that they're pushed to the second half of the year. So prudently, we've assumed guidance reflects a depletion for the first 9 months, and then the wells go in Q4 to bring production back up. If, as we hope, we can drill the wells earlier, we expect our guidance to be outperformed in 2020. But a nice, really low-cost, predictable cash-generative asset. As I say, it contributes between $5 and $6 million of free cash flow a year. We have 2 non-core assets that I won't spend too much time on. One is an asset called Northwest Gemsa that's coming to the end of its useful economic life. It will generate $500,000 to $1 million for us during this year. However, the production is declining, and if we can't increase production or reduce costs, we give our share, which is 50% of this asset, back to the Egyptian government. There's no exit cost, there's no decommissioning. It simply is an economic decision. If the asset doesn't generate cash flow under these contracts, you simply hand it back to the government. Thirdly, we have a non-core asset, which is very non-core because it's in the middle of the Gulf of Suez, and we class ourselves as very much a non-shore, low-cost operator. This is a legacy asset that has been in the portfolio for 7 years. It is a discovery. We will look to exit it at value, so we potentially will sell our stake for that. If we can't sell it, it starts producing this year. We will get about 150 barrels per day. It's very low, it's immaterial, it's not in our guidance of 7,000 barrels per day. As I say, it's non-core. We like to operate in areas where there's low operating cost, predictability. As I say, in the middle of the Gulf of Suez, it doesn't fit that model, so we're looking to exit that. I want to talk now about Morocco. Whilst I suspect most of you know that Egypt's a very mature hydrocarbon province, there's been gas and oil produced in Egypt since the 20s. Morocco's quite different. Morocco is still a developing or an emerging hydrocarbon province. And what happens in countries like that, the government really tries to attract foreign direct investment. And the way it does so is it offers extremely attractive fiscal terms. So in Morocco, where we produce and generate cash flow of around $15 to $17 million operating cash flow a year, there's a 10-year corporation tax holiday, which means that every license you produce will be tax-free for the first 10 years. What you tend to find is if you'd make a discovery in Morocco, it produces out before the end of 10 years. So at the moment, you've got a very attractive, effective tax-free environment. The other extremely attractive aspect about Morocco is that the gas prices in Morocco are extremely high compared to other jurisdictions that you'll be aware of. As you're aware, in the US, gas prices are below $2. In Egypt, our gas price is $2.85. In Morocco, we sell our production to 8 industrial customers at a gas price of between $10 and $12 an MCF. So there's a massive dislocation in terms of gas price. Morocco is by far the highest yielding asset that we have in terms of capital invested. The challenge that we have in Morocco is we want to find more reserves because we've got a country and a customer base that is extremely short gas. So when we went into our Moroccan business and looked at the market, our customers were paying the equivalent of $15 to $18 an MCF for their gas or for their equivalent of heavy fuel. For us to go in and sell it at $10 to $12, it's a very easy discussion to have with our customers. There is a significant undersupply over demand dynamic in Morocco, which makes it an extremely interesting country for us. The other thing that we are very happy to say is that our production into our Moroccan customers reduces the carbon dioxide emissions in Morocco by about 62,000 tonnes per year. These customers would be using fuel oil or LPG, and we are able to displace that. So there's a very strong ESG element to our business that I'm personally very proud of. So if we talk a little bit more about what we're doing in Morocco, As I've mentioned, we have 8 customers. We have a production target this year of just under 7 million standard cubic per day gross. Last year, or 2019, we produced 6.4. We sold 6.4. And our customers are on long-term fixed price contracts of between 5 and 10 years. They all have take-or-pay clauses. So it's a very, very nice, predictable utility for us. As long as we can deliver the gas to our customers, we have very strong, attractive gas sales contracts that we typically paid in 45 days for. So excellent, excellent commercial terms. I talked about the drilling program that we were embarking on in 2020. That drilling program made up of 8 wells. 5 of them are going to be in Morocco. To date, we have drilled 7 wells of a 12-well program in Morocco, and the remaining 5 will be completed in this quarter. Out of that 5 wells in Morocco, we will be drilling 5 exploration appraisal wells. Wells, again, that should have, upon success, a meaningful impact on the value of our business. To give you some perspective of where our assets are, this red line is the pipeline that we own in Morocco. The pipeline itself goes down into the 4th largest city in Morocco called Kenitra. Kenitra has a cadre of ceramics, paper manufacturers, car parts manufacturers, and there's a large economic development zone just to the north of Kenitra called the Atlantic Free Zone. So our pipeline from our gas field goes down, and then we put the last mile into our customers. So we've got really, really nice locked-in customers where our pipeline extends into their infrastructure. So this is the same map focused in on our gas field. That's the pipeline that goes down into Kenitra. We announced this morning that out of the first 7 wells that we've drilled, 5 have been discoveries. They've increased our existing reserves from 4 to 5 BCF up to around 7 to 8 BCF. From the 5 wells that we've drilled, we've now got reserves for the next 3 years to fulfill our gas sales contracts. We are, however, undertaking, as I say, some really interesting appraisal and exploration with 4 of the remaining 5 wells. That exploration has 2 objectives. The first objective is to see if this very, very mature and producing area, we've been producing from the wells in and around this pipeline for the last 8 years. We are putting 2 wells in, 1 up here and 1 slightly to the north, to see if that trend extends upwards. So this shallow biogenic gas that is very, very clear on the 3D that we've shot, and we can see that it works down here. We're testing, does this productive fairway that we fully understand and have drilled for 8 years and produced for 8 years, does it extend up there? Very interesting and exciting that, because that is a material step forward in terms of potentially increasing our reserve base. So that will be wells 8 and 9. 9 and 10. Wells 10 and 11, we will be taking up to this set of concessions we have up here, and we're drilling 2 wells up here. Now, the prospectivity and the gas reserves that we're chasing up here are quite different from the ones that we have successfully produced down here. They're different because they're larger. If you can see the marks here, the lines here correlate to the size of the reserves that we're chasing. The sort of red and oranges the 2 wells that we're chasing up here are about 4 times the size in terms of potential compared to the ones that we have produced here. 2 wells will go in there to see if we have got a new play fairway, a deeper play fairway. This is potentially got some liquids in it, so it's gas and potentially condensate and or oil that we're chasing up here. And again, it's something that we haven't commercialised in the past, and success up here will fundamentally change the overall value proposition of this Moroccan business. And the last well in our campaign, we're coming all the way down here again to drill a well called KSR 17, which hopefully will add another 6 or 7 months of reserves to our 2 to 3 year reserve base. So a very exciting and interesting and diverse portfolio here in Morocco with regards to what we are looking to do. Finally, I just talked about, before I get to the Q&A, we're very well funded. We had $11 million of cash at the end of the year. We have $7 million of an undrawn debt facility, and our business generates, from its operating cash flows in 2020, will generate approximately $30 to $33 million of operating cash flow before CapEx. So as I say, we have a very interesting, catalyst-rich work programme, which is summarised here. These are the 2 wells in South to Souq that look to double our South to Souq reserves and potentially take our corporate reserve life up from 5 to just over 9 years. This is, these are our wells in our little cash cow. 1 hopefully will be drilled in Q1. Wells 2 and 3 will be drilled in Q3. And this is our Moroccan drilling campaign that I've talked about. So in summary, we have a very simple producing business that's got good, predictable free cash flow of $30 to $33 million a year. We have another 8 to 9 wells to drill in 2020, which are fully funded. 8 of them will be drilled in the first 6 months. And we've got the potential to increase our reserve life from 5 to 9 years. And we are currently valued at 2 times our 2020 cash flows. So I'll be happy to take some questions.
Fantastic. Actually, I've got one very quickly.
Sure.
Slide 17, in Morocco.
Yes.
Presumably if 9 and 10 and 11 and 12 work, you'll extend the pipeline up.
Yes, there's a couple of options here. I mean, we will either look at extending the pipeline or introduce a very simple CNG model where we, for a much lower cost, would put some compression at the wellheads, bring in some trucks and truck the product down to our customers. Yeah. So it will be a question of, is the size of the reserve justified to extend the pipeline, or else do we do a lower cost option and just move the gas through trucks?
My other question, sorry, very quickly, is given the differential in price in Morocco, how come nobody's shipping it in by the tanker load?
So there isn't any LNG off-take facilities at all in Morocco. The way Morocco gets its gas is there's a pipeline from Algeria, goes up into Spain. Morocco takes effectively a right of use portion of gas from that, and that feeds the power stations, and the rest of it is imported in LPG cylinders. Right. So there's a real competitive dynamic that we are, unfortunately for us, being able to exploit just now, that they are so short of being able to bring in, comparably priced gas. Yeah.
Hi there. Hi. Very good presentation, very interesting. Just to ask, as a small company, how do you protect future income streams? Do you have forward pricing agreements for your gas sales? Conscious that the gas is a volatile commodity in terms of price. Do you build in some kind of protection for yourself?
So all of our gas contracts are fixed price gas contracts, so we have no exposure at all to commodity prices. That's why a lot of the investors like us, because the predictability of our business and the take-or-pay clauses in our contracts as well gives us extra surety. So our gas business is like a utility. As long as we can keep finding and delivering gas, we have a very predictable and understandable revenue stream that's protected from commodity price.